Most traders, most traders will not are not prepared to accept the fact that the market is going to do what the market is going to do. It has a rhythm. It has no independent mind, but it's controlled by millions of orders that's complexly being put into the market by one thing: accepting the risk. Accepting the risk. And I want to work with you in that area today, accepting the financial risk. So this is what I want to say to you right now. Two things that will be required of you to accept the risk. One, you must have confidence. Confidence in yourself, confidence in your decision to take a trade, whether it be long or short, confidence that you know what you're doing, confidence that your edge will work. Now, confidence doesn't mean that the outcome is going to be assured. Confidence means that you just have the ability to push that button and take that trade without knowing what's going to be on the other side of it. Because when you push the button to get in that trade, you don't know what's going to happen next. You have no control of it. The only thing that you have control of is what? To take the trade, to understand your risk, and to take profit. That's all you control in that scenario. But the thing what happens to a lot of us as traders, we lack the confidence in our edge. We lack the confidence in our technicals. We lack the confidence in our self. So we'll see the trade come about, meaning that we've done the research, we did our technicals, we know our levels are marked off. When the price gets here, we're supposed to push the button, get into the trade, and hopefully it turns out in our favor. But a lot of times we get to the place where everything lines up, but we hesitate to push the button. We say, well, let me wait and see whether or not this is going to work. And if it does, then I'm going to get in. Have that ever happened to anyone? Type it in the chat box where you know your trade came in, your edge was there, but you didn't push the button. I need you guys to type in, because the more you type in the chat box, the better I'm going to get. If you don't type, I got to slow down and think I'm not getting through to you. Definitely. And I experienced the same thing, guys. I've gotten past a lot of it, but there are times where I lack to push the button because I'm not sure. But not often, but it does creep up on me. And one of the things I want to do today, hopefully, is to help you to develop the confidence in your edge through the weekly coachings that we're going to be doing, and also understand the opportunities comes about and you are not responsible for the outcome. I want you to relieve yourself all the pressure. You are not responsible for the outcome. Second thing I think that is essential for you to have is a winning attitude, meaning that even though you don't know what's going to happen once you push that button to get into that trade, whether or not it's going to go in your favor or go against you, you still have the confidence that you are taking a trade because your signals are there, your edge has met the requirements, and you're willing to take the trade. You may hear me say this all the time, 50-50, right? 50-50. That means that I really don't know if it's going to go up or down, but I'm going to take the trade. And when you have your edge in place, guess what? You're going to take every trade that meets your requirements to put on the trade. So confidence will require two things, I believe it would be for you. First thing I'll say, you would need to have you have to be unencumbered by fears and worries. This right here, guys, I believe is one of the biggest things that we deal with as traders. Fear. Fear, false evidence appearing real. That's what fear is. False evidence appearing real. You're fearing something that could happen, that probably won't happen. It may never happen, but yet that fear tends to paralyze you. Perfect example. You get into a trade, you take the trade, and the trade goes against you. You come into what we call market paralysis. It's going against you. You know, you say, I'm going to stop myself out if it goes against me at 10%. It hits the 10%, then it goes 20% and 30%. You like to see it. And you want to push the button, but you don't push the button. What could cause you to be in a trade that's going against you, to stay in that trade, even though you see it going against your bottom line, your P&L? Anybody here that been in that situation where you got the trade and it went against you and you did not get out of the trade? Anybody? Type it in. And if you did, what was it that was on your mind that caused you not to get out of the trade at the plan that you had? Meaning that My plan was to only risk 10% on this trade because I did the research. I measured everything out. 10% stop should work on the trade if it works for me. And if not, then I'll stop out. And you let it went past your stop and stay in the trade. Who else? JR? Yep. Jack? Yep. And I have two, guys. I have two. Dexter? Yep. Okay. So we see this here, right? And what makes us do that? One thing I would say is that fear of being wrong or fear of missing out. This was fear of missing out is that you have a small account. You took the trade. You got your last bit of trade on the table today. You up, you're green, but you put your last trade in. And if you cut this trade, you won't be able to trade anymore till tomorrow because the settlements won't happen till tomorrow. So you stay in the trade, hoping it comes back, and you end up losing more than you ever planned to lose because you held too long. And then you went from red to green that day, ended red. And that didn't happen to you guys. Where you was green, got that last trade and broke your rules and then end up losing out. Yep. Jay said, yep. Yep. Aisha, yep. And we're going to break that, guys. We're going to break that with some understanding. So I say that unencumbered by fears, we're going to help you get rid of the fears. Because one thing I'll tell you here for sure, the market is going to do what the market's going to do. It's 50-50 every time you push that button. No matter how much research you did, no matter how well you did your levels, the market is going to do what the market is going to do. The reason is the market is being controlled by millions of people trading at any given time, putting in orders, buying and selling orders. And one thing I want you to understand too, every time you lose, somebody else on the other end won. Okay? There's always going to be a winner and a loser on every trade. When you have a big win and you've won on a trade, then that means that someone else on the other end of that trade lost money. So there's always going to be a winner and there's always going to be a loser. Your goal is to be on the side of the winner most of the time. Your goal is to be on the side of the winner most of the time. See, when you're feeling confident and uncovered by fears and worry, it's not difficult to put on a good trade. I mean, you see it, you push the button, you get right in. It's easy. You're in the flow. You're in the flow of things. And that's what I want you guys to do, to develop that winning attitude so you be in the flow of things. When you have the winning attitude, it helps you find your flow. It helps you find your natural rhythm. You ever been in a string of winning trades where you trade in and today you 5 for 5? Man, you get real confident, don't you, in your trades. You're like, whoa, I got this going on. It's like it's easy to push the button because your confidence is built up. Now, when you're on the other side of that, you're not having a good day, then it's not so easy to push the button, and it seems to be snowballing. I have people right now that's sharing with me that they have a string of bad days, red days. They can't get a winning trade in. So why is that? And I'll tell you guys, it's in the mind, it's mindset. And I want to help you guys with the mindset portion of this here. So 2 things you need, confidence, you need a winning attitude. With a winning attitude, you will find your flow, your rhythm. You will be uncovered by fears. Now, what does that mean? There is no concern. There is concern. But see, when you don't really understand the risk that it takes to trade any individual underlying or commodity or stock or ticker, then you will have a fear. So one of the things that I teach at DTC Coaching is this here, is that I teach you how to measure the risk. I teach you how to look at the underlying that you're going to be trading, and you're going to examine it over a period of time to see how does it behave. And this is one of the reasons why, that understanding, I'm able to measure out what would be an acceptable risk for me to get into that trade. What does that mean, Kelvin? That means that if I take a trade on any given time frame, most characteristics of a stock does about the same thing on average, the same way. So a trade will start at, let's say, $1. And when that candlestick starts, it starts to pull back on you. When it pulls back, what it's actually doing is pulling back into the market, picking up unfilled orders, using that liquidity to move to the next level to go get the other orders, because it's always searching to fill orders. That's what the market does. They have buyers looking for sellers and sellers looking for buyers, and the market will move them 2 guys together till they meet and agree upon price, and they sell to each other or sell and buy from each other, and that keeps the market moving. That makes your market go up and down. So being that you understand that, when you take your trade, then you say, then if I take the trade here, what is the probability of things going to happen? Because one of the things I spoke about last week, that you're a probability master. You work in the area of probabilities. If I take this trade here, what's the probability of this trade going in my favor or going against me? And if it does, how much would it go against me? And your stop is just here. Your stop is just insurance. It's what it is. It's an emergency exit for you. Your stop is not designed to say that I'm going to take this trade and only risk $10. You might as well just write a check and give it to the market. Because let's say this here. Let's say that you use, let's say SPY. That's a good example. If you trade in SPY, I trade the 30-minute candles on SPY. I trade the 30-minute candles on SPX. I use the lower time frame to enter, but a 30-minute candle. Well, the average pullback on SPY with a new candle runs between 80 cents and $1. Hear this out. Meaning that the candlestick will start and it will pull back the opposite direction that the trade is going to run in up to 80 cents, maybe get to $1 every now and then, but 80 cents is about where it averages at. So if you take a SPY trade and you put your stop at 20 cents on a 30-minute candle, guess what happens? That's $20 risk that is going to come back and stop you out and take off. Have that ever happened to you guys where you take a trade and that pullback when you take the trade takes you out before the trade ever gets started? The thing I teach here at DTC Coaching is that I teach you how to price action trade, to trade that trade where I got a system called a Kelvin, where you miss that whole pullback, but you take the trade on the momentum side, and when you push the button, on average, it'll pull you in 2 to 3% into the trade in the right direction where you won't get stopped out. That right there will help boost your confidence, because I believe every one of you guys in this room can be a 50-50 trader, meaning that you will win 50% of your trades. You will have a green trade, 50% you will lose. Now, you probably will be between 50 and 70% with the proper techniques. So it's not necessary that you have to get stopped out on all your trades, but what you really have to understand is the risk dynamics that you have to do to trade any underlying. So if you're trading a bunch of different tickers, then I would suggest that you minimize it down to 2 or 3 different tickers that you like. Study them, understand the rhythm of how they work, and then from that point there, you can pretty much take a trade, know how it's going to act once you get into it. You know when you want to execute to get into the trade, and then that'll help you develop your natural rhythm that you need, that'll help build your confidence. Because let's say this here, if you trade in, like I have been, over 60-day trading days, and 56 of the days are 100% days, do you think my confidence is kind of high? Yeah, my confidence is through the roof. I mean, I have no trouble. I take every trade that meets my edge. My edge is just this here. I have defined a certain place in the stock or in the characteristics of the stock where I can take a trade and my win ratio is about 50 to 70% on that trade. So anytime it comes up, I just push the button. I have no fear. I have no emotional ties to it, but I take the trade because I have an edge. Every one of you guys in this room right now have an edge. Whether it's developed or not, whether you even recognize it or not, I don't know. But you have an edge because every time you make a decision to get into the trade, something in the charts, something has happened in the candlesticks that give you the notion that I can take the trade here and possibly make some money. Okay? Now, the difference in me and a lot of traders is that my goal is to go in and take money out of the market. Others take that same trade and they're trying to figure out how much they're willing to lose in the market. Mindset. Now, this is the difference. How much I'm going to take for the market versus how much I'm willing to lose to the market. Right off the bat, when you think in an area of what you're going to lose to the market, you have already defeated yourself. When you say that I'm only willing to give $25 to the market, then what you're saying is that I don't really want nothing from you, Mr. Market. I just want you to take something from me, $25, $50, $100, $200, whatever that is. You have literally set yourself up to fail because just the way you're approaching the market, because your attitude is wrong. So if you go in the market and says, I'm only willing to risk this, that tells me 2 things. 1, you didn't do your homework. 2, you didn't do the research on how the market truly responds when it goes into, if you're trading a 5-minute candle, 2-minute candle, whatever candle you're using, there's certain characteristics when you take the trade. Are you taking a trade when the candle is pulling back on you? Or are you taking a trade when the candlestick is moving from you? So if you have a string of losing trades, chances are you need to do a mind reset to when you take the trade, you're not taking the trade when it's coming against you. You're not taking the trade saying, I'm going to take this trade, but I'm only willing to risk $25. Listen to the differences here. This is very important. If I understand that a stock generally pulls back on a new candle, 50 cents, 75 cents, a dollar, whatever that is, and I want to take the trade, and I'm only willing to put up $25 of a risk, am I putting myself in position to win on that trade? Answer in the chat box. I'll answer for me, but the answer is no. So your risk, listen to this good, your stop is not to give that money to the market. Your stop is a fire sale, a fire insurance. See, just like car insurance, you pay it every year, but you haven't had a wreck in 10 years. You have it just in case, right? So your stop is just in case the trade goes wrong with you. But if your stop is too tight, that trade is going to stop you out and you're going to have a losing trade where you could have had a winning trade. Then that means that you're going to come back, get stopped out. You're going to go in again, get stopped out. You can't figure out why you keep getting stopped out because your stop is misplaced. So I want you to do this here. This is a free tip. On the underline that you're trading, go through and measure the wicks on all the candles that's going in the bullish direction, the largest wicks, and see what they are. Find out the average size of them in the bullish directions and the bearish directions and see what they are. And once you figure out what the average pullbacks on the candles are, then your risk just in case insurance or your stop must exceed that average pullback so you can stay in the trade. But let's say this here. If the average pullback is 80 cents and I have a 50-cent stop on the trade, then on average, I'm going to get stopped out 7 out of 10 times. Would you agree? Type in the chat box. Would you agree? I'm going to guys, I don't hear nothing. I don't see nothing typing in. Yes. Okay. Yes. 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 The reason is that you haven't read the requirements to trade that underlying. You haven't read the top requirement to trade that stock. So if I know it's 80 cents, then what I want to do, I want to take and put my stop 20 cents or 10 cents or 5 cents beyond the 80 cents. So when it does its natural pullback, guess what? It doesn't touch my stop. You see, the money that you put in your stop is perceived that you can lose that money, but you can lose it if you haven't missed a stop. But if you set the stop right, it'll pull back, but it won't touch your stop. That's called just in case it goes horribly wrong, it'll get me out of the trade. But if you know that you was going to take a trade and that trade would not stop you out, would you have a problem putting a stop on the stock that pulls back 50 cents? You wouldn't, because it's not meaning that you're going to lose the money. It's just in case the stock does not do what you plan for it to do. This is your emergency exit. That's what that stop is for. So I want you to start thinking about your stops in that way, not in the area where you're saying that I'm only willing to give this to the market. That's a defeated attitude. Every time you take a trade, you're taking a trade to win, not to lose. You're taking a trade to take money out of the market, not put money into the market. You don't want to be the liquidity for somebody else in the market. So what you're going to do, I'm going to measure twice and cut once. I'm going to measure these wicks out. I'm going to see what the average pullbacks on these stocks are so that if I'm going to trade this here, and if that pullback is too great for my risk tolerance, then I must pick another entry. I can't enter there. So that means that you may, instead of trade a 30-minute candle, you may trade a 5-minute candle. The wicks are different there. You may trade a 2-minute candle. The wicks are different there. But whatever that is, you need to figure that formula out, because I think that right there is key to most of us are losing in our trades. Now, if you knew that to be true, would you ever have a trouble pulling the trigger on a trade where you know that you're not going to get stopped out? Would you take every trade that meets your edge, put yes in the box or no in the box? Every trade, no thinking about it, no fear, no nothing. Just get into the trade. Okay, all right, good. Now, I'm going to share with you guys another truth here. The reason that you have the hesitation, because when you lose money, it's painful. Would you guys agree? It hurts to give your money to the market. You know, I know some of us here have experienced days where we've lost $500, $5,000, $3,000. I mean, daily, we're losing that kind of money. And that hurts. It's painful. So what it does, we still come back the next day, we trade, we hope, we pray, we chant, we do all kind of stuff to hope this market move for us. And I think Them things are great, but none of them things are going to help you in your trading. Only thing going to help you in your trading is clearly defining your edge and accepting the risk to trade that underlying and knowing how it works so that you can properly adjust your stops so you don't get stopped out. If you knew that you can take 10 trades and 7 of them will be winners, would you ever have a trouble pushing that button? And I believe the answer is overwhelmingly no. You will push that button. Now, what I want you to do at this point from today forward is not thinking in the term of what I'm willing to give to the market, but what is required for me to trade this underlying and be successful at this trade. That's what I want you to pay attention to. I want you to have the winning attitude that if I use this parameters, because I've measured once, measured twice, and cut once, I know exactly what the risk tolerances are for this underlying, then I'm going to set my stop accordingly. If that stop is too great, let's say that for SPY, I say it's $1 that's $100 for one contract. That's 100 ticks basically. Okay, if it's $1 tick, if I cannot stomach $100 drawdown or on that stock, then I can't trade that stock, or I have to trade it on a different time frame. This is what I would say to you: the lower the time frame, the more erratic the stock moves. Okay, I have found that trading a 30-minute candle, I have more control of the rhythm of the move of the trade than I have on a 5-minute candle, because it doesn't take much strength to break a 5-minute or 3-minute candle high or low, because it's such low amount of orders. But when you start getting into the 15, 30, and 1 hour candles, it takes a lot of momentum to break the structure of them in the candles, to go from the high, break the high or lower the candles. So I find that even though they're higher threshold for the candlesticks, but even though the risk is greater, but I actually have more success trading a 30-minute candle than I do trading a 5 or 3-minute candle. True statement. True statement. So if there's any kind of way, if you were working with the belief that all your trades, 7 out of 10 of them will work, would you have any trouble taking a trade? And the answer is overwhelmingly no. Everybody in this room will take that trade. That means that 7 out of 10 trades you win at, you're going to make good money. So the thing, what I would say to you is this here. 1, clearly define your risk. Clearly understand the underlying that you're trading, whether it be SPY, XPX, Apple, Tesla, whatever it is that you're trading. Understand how that stock moves. That means that for a student, I'm not speaking to you about trend lines and nothing like that. I'm talking about looking at the actual candlesticks and the wicks that it produced. Go back over the several days and measure the wicks on the candlesticks, measure the body of the candlesticks. And once you get that understanding, you're going to start to see a pattern of how them stocks move, how they breathe, how they operate. And then you're going to set your risk parameter around how they work, not how you want them to work, because see, the market is going to do what the market's going to do. You can't control that, right? But you can control how you're going to approach the market, your mindset, and how you're going to set your risk appropriately for it. If you cannot take $100 or $200 or $300 drawdown on a certain underlying, then don't trade that commodity. Don't trade that stock. Trade something that will fit your risk profile. Another caveat for you: don't trade things that are out of your budget. If you have a small account, you should not be trading SPX. I'll say that one more time. If you have a small account, you should not be trading XPX. If you have a small account, you should not be trading Tesla. If you have a small account, you should not be trading Google. Meaning that if you want to trade something with volatility, find a stock that moves, that fits your portfolio size. Okay, I see people right now today, they're trading SPX with a $5,000 account. They're trading Google with a $10,000 account. Them underlines will wreck your account with one bad trade. So I would say to you, find something that will fit your portfolio size and size in accordingly. Don't oversize. One of the biggest things I find happens to us is that we should be trading 2 contracts, but today the market's ready. We'll put 5 contracts on. And what happens is it's here. The 5 contracts you put on, the same risk, whether it be 25 cents or $25, times 5 is $125, right? And so if that be the case, when that stock moves back about 25 ticks, you're down $125. When it moves back 50 ticks, you're down $250. Now you're getting paranoid, your mind getting skewed, and now you're starting to panic. Instead of watching the trade, you're watching the tickers to see how much money you're losing. And that's why on my charts, guys, I don't have P&L nowhere on my charts. I have percentages. I don't watch the dollar amount, because if I was to watch the dollar amounts, it'll freak me out too. It'll freak me out too. So what I say to you is, don't watch your P&L, watch your candlesticks. Know your entries, know your exits. Remember, the only thing you can control is when you enter, how much risk you're going to put on, and when you're going to take profit in the market. Everything else is 50-50. Everything else is 50-50. So I don't want you guys to be in a situation where you're putting yourself where you're in harm's way, because the market is, whatever you may think, the market is not against you. No matter what you think, the market is not against you. The market has no address on you, don't know your IP. And I know you feel like it sometimes. You push the button, as soon as you push the button, the market goes a whole different direction. You say, whoa, Lord, what's going on here? But you got to understand, the market is not against you. The market doesn't know who you are. But what is against you is your mind. What is against you is your fear. What is against you is your lack of confidence. So what I want you to do is do your homework this weekend. Whatever them stocks that you like to trade, research them. Now, what I would say to you is this here. If you're trading 10 different tickers, stop. My goal is, my reason is for trading is that I want volatility, okay? I want stock that will move $100 a day. That's what I'm looking for. And I found SPX, SPY, they move so much distance in one day that I can make all the income that I want to make from it without trading anything else. So why would I trade a different underline or a different ticker if SPY or XPX is giving me all I want? There's no reason. So you'll see me only trading one thing. I know people think I don't take their trades. I don't, because I understand that all I want is volatility. If I got one stock that's doing it, then I'm stick with that one stock. And I understand it. So I want you to understand the stock. So this is what I'll say to you now. The market is not against you. The market is not against you. So stop thinking that every time you take a trade, the market is going against you. It's not going against you. You have to take responsibility for your own trades. What does that mean, Kelvin? That means that you are solely responsible for pushing the button to get in the trade. You're solely responsible for getting out of the trade. You're solely responsible for taking profits. Okay? Now, in a probabilistic society environment, as the market, the trading market, is that I have to get into the market to get anything out of the market. So if it's built on probabilities, then what I want to do is get as much probabilities in my favor as possible. So what I do is I study trend lines. I study breaking the high and lows of the previous high candles, like 30-minute, 1-hour candles, breaking the highs and lows of the days, breaking VWAP. All these things here give me an edge, an actionable signal. I look for momentum to go into all of my plays. So what this does is it increases my probability of having a successful trade. So let's say that you are trading like day before yesterday, in the chop. It chopped all day, stayed on the point of control, all just bounced around and never went out of a $30 range. Well, a novice trader or a beginner trader tried to trade that and they got chewed up and they lost more money that day than they wanted to lose comfortable with. I traded that same day. I didn't make as much as I normally make, but I did get out the day being green, and a lot of the day I did not trade. Now, you have to understand, when the market does not present a favorable environment, you should not be trading it, period. Okay? Should not be trading. So if you are, then understand chop. You might hear me say this in my trading. It is chopping around, guys. Go to your lower time frame, measure out the last hour that trade, draw a box around that area of chop, and don't trade. They call it no trade zone, and wait till it breaks structured high or low of it, and then take the trade for that portion there. Market is not against you. 8 rules I want you to remember while you're trading. 1, know yourself. What does that mean? If you want to willy-nilly trader, just push the button and don't accept your risk and doing things wrong. Know where your weaknesses are and strengthen them up. Read some books. Know your self-talk. If you're talking negative to yourself, well, it's always going against me. I never have no good luck. Man, I can't make no money. Well, you just sabotage your trade. You just sabotage your trade. You are a winner. You are market always paying you. Well, you may be losing because you're going to speak your future self out. Because believe it or not, you're a speaking spirit. What you say, you create. So you keep saying, I can't. You keep saying, I don't. You keep saying, I never make money. Guess what? Your subconscious mind registers that and it produces just what you asked for. Meaning that you're looking at the charts, you're trying to make a trade and it's giving you false information. Not the charts, but your mind. And you make a decision and they all go against you. So know yourself. If you got bad self-talk, then go out and read some self-help books to start changing your thinking. Okay, because thinking will get you in trouble. Next thing I'll say, have a plan. If you don't have a strategy, you don't have a plan to how you're going to get in the trade, out of the trade, know the risk in place, guess what? The market will make a plan for you. And the market is the only environment that I know of that there's no rules. The only rule is, long as you have money, you can play. When your money run out, we're going to kick you out of the game. Market, the only thing that's there that you can put it in there and you come trade going against you, market said, okay, you're not out of money. You can stay in the game long as you want to. And that's never what you want, guys. Never what you want. You want to know your game. You want to have a strategy. That means your playbook. Do you have a playbook in place? Meaning that I only take these trades when I have these signals coming out. My risk is always going to be here. I'm going to always get out when it reaches this criteria, and I'm going to take profit at this level. You may hear me when I'm trading and say, well, right here, because when my rule is that I'm going to run and trade, it pulls back 25%, boom, I take half off the table. Half the trade just boom, I don't even think about it, half off. That means if it comes back to my break-even point, I get out the trade, I still made money. See, I believe in paying myself in the market. So if you're trading more than one contract, then you always pay yourself. The market shows weakness in the run, take half off the table. Don't cut your trade, but take half off the table. If you're trading one contract, it starts to pull back on your initial entry and about 25%, cut the trade. Pay yourself. Don't have a red day, have a green day. Know your market. What does that mean? Every day you should get up and chart your chart before the morning, meaning that look at where the market is at, look at any moving averages that it may have been rejected at or bounced off of, look at the VWAP where it's at, look at the previous day, the previous hour, the previous week, and see all these things to see there's a trend there. Much information as you can, so when you get to the place of your edge, you can have confidence in taking a trade that shows up on yourself. Okay? Next one I say, start small. Don't be out there trying to trade 10 and 20 contracts, because this is what I'll say to you. The pressure that will come up on you trading multiple contracts is much greater than $50 if you had 25 ticks against, or $50 for two contracts against you versus $500. The mindset is totally different, of $5,000. So start small, meaning that trade one or two contracts. Do this here, trade one contract till you become a break-even trader. Once you become a break-even trader, then you can go up to two contracts. And then when you get in the trade, 10, 20% in the trade, take one of the contracts off, set to stop the break-even and let it run. But the goal is every trade should be a winner. And it's very rare that we will push the button and the trade immediately goes against us. Most times we'll get a couple of ticks in our favor. So if you know that you are getting in, your execution is not that great yet, and it presents you 5%, take 5% out the market. You keep taking 5% every day. What's going to happen is your confidence is going to get greater. Your attitude is going to change. Your ability to say, I can, going to kick in place. And believe it, guys, 90% of your pass or failure is in your mind. So if I can think it, I can have it. It is that if your mind can conceive it, your body will achieve it. So you got to change your self-talk. You got to believe where you are and believe in your edge. So start small, build your confidence up, then graduate up to a bigger trading later in time. Don't chase the dollars chase you. Chase performance, chase winning trades. Be a 50-50 trader, and that's going to help you tremendously. Next thing I'll say, keep it simple, guys. Now, I've seen some charts. My chart is pretty busy. Not really, but they got every oscillator, every CCL meter, every widget on the think about on the chart, and it's confusing. Simplify your charts. On my charts, I have Basically, I have the 50, the 200 moving average, and the VWAP. I take everything else off. I do have my marking my daily highs and lows and things of that nature. When the important areas, because I'm a level trader. I break levels, I take trades, and I get in then my actionable signals. So make sure that you keep it simple. If your chart is too busy, make it unbusy. Okay, I'll take some of the business off. Be wary of leverage, meaning that you get in a place where you're making a trade and then you're going to try to leverage in because you're trying to revenge trading. Okay, you lost $500, but now you're going to double up on this trade here, and then you lose twice as much, and then you find this hole getting bigger and bigger and bigger. Don't do that. It makes no sense to put yourself deeper in the hole. If you're having a string of 3 bad trades, turn the computer off. Go take a break. You can come back and trade another day, because once your mind gets in the area of a defeatist attitude, you'll start losing money quicker than you ever can think about. And you know, red day gets redder. Keep records. This is one of the hardest things I found for traders to do, is that they don't like to chart. I mean, not to chart, to journal their trades. You know why? Because it's painful to sit down and say, man, I lost $500 on this trade. You don't want to talk about it. You want to get away from the trade as fast as possible. But that's the worst thing you can do. See, if you don't review your trades and the mistakes that you made, then chances are you're going to keep repeating the same trades, the same mistakes. So review your trades, journal every trade. If you say, I'm trading so much I can't journal them, then trade less. But if you don't journal your trades, then you're setting yourself up for failure or repeated failure. The next thing I say to you, aim to minimize your losses rather than maximize your gains. This is what I find people do more than anything. They'll take and they'll say, I'm putting in here I want to get $500 out of this trade. Well, at the same time, they'll jeopardize $1,000 on their losses because they're trying to get to that $500, and they did not putting in proper risk management. Before you push that button, you must have an exit strategy. Before you push that button, you must know where you want to go at, and then take profit in when they get to that area. But don't focus on how much you're going to make, because the market is going to do what the market is going to do. You just push the button and have no expectations. This is important, guys. Reduce your I don't expect, every time I take a trade, I don't expect the market to give me anything. I honestly have no expectations. I push the button and I say, oh, I'm up 10%, I'm up 20%. I get excited, right? And the worst thing you can do is say, I'm trying to get the $500 and you get the $499, and then the thing turn around and then you end up taking a 20% loss. Have that ever happened to you guys? Yeah. So let's look at a scenario here. Risk matters, okay? Let's use an example. If you took 100 trades and you're a 50-50 trader, you put on 50 trades, $1,000 per trade, and that's $50,000 you put into 50 trades. You had losing trades, you had 50 losing trades, and you lost average of $500 per trade. That means you lost $25,000, you made $50,000, you netted $25,000. Are you a winning trader? The answer is yes. So a 50-50 trader with the right risk management in place, meaning that you can be a successful trader and you can make money on the whim whenever you're ready to. Okay? Next one I'll say to you is this here. Good qualities of a winning trader is this. Consistent growth in your mindset. The mind first. Consistent growth. Okay? The next one is managing your risk. Very important, guys. Know your risk and manage your risk. Next, thinking independently. Don't wait for somebody to call a trade out on the Discord. Don't wait for somebody else to tell you when to get in the trade. You should know when you're going to get in that trade. You should know why you're getting in that trade. You know, why are you cutting that trade? Why are you accepting a loss in that trade? That is your responsibility, not the market's responsibility, not the Discord responsibility, but your responsibility. And if you don't know, get with someone to help them develop your trading strategy, your trading plan. And that's what we do at DTC Coaching. We help you to put together a strategic plan. I'm a strategy coach on how you're going to approach the market, your risk, and where you're looking to go at in the market. Have confidence in your trades. That means that if your edge shows up, you're going to push the button, you're going to get in. And the last thing I'll say to you is never quit. Never quit. Here's 2 things here for your account size here that I think that will help you out. The 1% rule for day traders. Limit all risk on any given trade to no more than 1% of your total total account value. Okay. Traders can risk up to 1% of their account by trading either large positions with a tight stop or small position with a loose stop and place it far enough from the entry price. What that means, knowing your trade. So what they're saying is that trade a cheaper stock, you can have a looser stop and you can pallet it. You trade an expensive stop like SPX, you have a tight stop, you're going to get stopped out more than normal because the risk parameter won't be acceptable for that underlying, meaning that you can make money on it, but it won't be a 70-30 win rate or 50-50 win rate. It'll be something like a 20-80 win rate, and meaning that you're going to lose 80% of the time, and them little losses add up because the risk or the stop is not acceptable for that trade. Another popular method is the 2% rule, which means that you never put more than 2% of your account equity at risk on any one trade. If you're trading a $50,000 account, then you should choose a risk management stop loss of 2%, or you can risk up to $1,000 on any given trade. That's a rule. It's not ironclad, but does it meet your rule? That's the question. Does it meet your rule? Here's the saying for you. I did this last week. I'm going to do it again for you guys. I'm a consistent winner. It's your self-talk. I'm a consistent winner because why? I objectively identify my edges. I predefine my risk on every trade. I accept the risk, or I'm willing to let the trade go. I act on my edges without reservation or hesitation. I pay myself as the market make money available for me. That means I scale out. That's what it means. I'm continually monitor my susceptibility to making errors. You see, when you're on a winning streak, you can do some foolish things. Oh, I made a big gain here, and I made another big gain there. Then you start to get loose, and you start with your trades, and then you put on even doubling up on your trades, and then you give all your winnings back. So don't do that. When you're on a winning streak, take a break, walk away, reset. But don't get so your euphoria kicks in, you start doing them willy-nilly trades thinking you're invincible and you're the market maker, you make things happen. I have to keep myself in check all the time because I do win, but I have to keep myself grounded. I don't do the foolish things that I see traders do and give all their winnings back. I don't believe in giving nothing back to the market. The last one will be is I understand the absolute necessity of these principles and consistent success. And therefore, I never violate these rules. Now, guys, I'm going to drop something in Discord tomorrow to help you guys out, to help you measure your stop. It's called a scorecard. And you're going to measure your stops, measure your things out, and hopefully help you develop an edge for your trading. So at this point here, I'm going to open the floor up for some